Welcome back. In this video, what I would like to do is to go over the 6 different pieces of internal controls. No matter what, it doesn't matter who you are in an organization. I know that there's a lot of, Sarbanes-Oxley stuff that holds CEOs more accountable and things like that. But everyone in an organization needs to understand at a very minimum what internal controls are, how they're used, why they exist, and this is the best way for a company to be able to identify if there is any kind of fraud or bad behavior going on. And so everyone should understand these and know what they mean. Also, as a small business owner, one thing that you never ever want to do is to give away control of your money to an accountant. There are many business owners out there who may hire a CPA to put together their books, to do journal entries, to do some of the minutia that is required in the accounting world. However, every business owner should have some controls established around their financial statements, around their cash flow, things like that, to make sure that an accountant will not rob you blind. And with these 6 different types of internal controls, you can ensure or at least minimize any risk you may have. So let's go through these now. Control number 1 is to establish responsibility. And what this means, and you can see this often at retail stores. If you go anywhere and buy product today where there's a cash register, if you really pay attention, there's only one person at a time who is signed into the cash register. And there's a reason for that. When accountants want to trace back to find out, okay, during this 3-hour period, so-and-so was on the cash register and we were off by $10. It can help to pinpoint where something could be going wrong, or specifically what a person might be doing wrong in handling the money. Also, if you really pay attention at a retail establishment, there is only one person who counts the cash in the drawer. Only one. Next, and this is very much related to the establishment of responsibility. I think that these 2 controls, the establishing responsibility and the separation of duties, can often get confused. So let me explain what separation of duties mean. Basically, what this is that you don't want the same person doing certain types of activities. Just like in that retail example, we don't want one person running the cash register as well as counting the money. And I think it should be pretty obvious as to why we don't want that to happen. But you can also see this in other places. So, for example, in procurement, you don't want the same person creating the purchase order, receiving the product, and paying the bill. At the very least, you need that separated at least into 2 people, and best, it's better being 3 people. And in really large companies, this is often 3 different departments, which makes separation of duties pretty cool. Consequently, you do not want the same person creating an order, shipping the product, and receiving payment for those orders. The third control is documentation. And often what people understand this to be is that certain kinds of documents need to be pre-numbered. For example, if you've got purchase orders, every purchase order should have its own number or sequence of letters and numbers or something that can give a clue as to, oh, there's a purchase order missing, or something like that. Also, invoices should be pre-numbered. Bank slips should be pre-numbered. There are all kinds of documents that need to be pre-numbered so that if you see that there's a gap in between, just like checks, when you're doing a bank reconciliation, it's like, oh, there's a check missing. Why is that? And sometimes there's a valid reason for it. Perhaps a check has been voided for whatever reasons. So there are acceptable reasons why something would be missing, but sometimes it can also hint to there's some sort of activity going on that should not be. In addition to pre-numbered documents, there's certain things that happen in a business that are financial related that you want documentation of. For example, when you are paying an invoice to a supplier, you want, as part of the backup of that document, of that invoice, you want to have a copy of the purchase order. You also want to have a copy of the receipt. You should always check to make sure that the proper signatures are there, or any other supporting information that needs to be there. And all of those pieces need to be in place in order to actually pay the bill. This does not mean that 100% of the time that you'll have those. For example, sometimes your utility bills come in, and maybe there's a master PO or something like that. That can certainly be the case. But probably 80 to 90% of your invoices that come in, especially if you're a manufacturing company, you're buying from suppliers, you want those to have all that backup, as well as journal entries. You don't want an accountant to just write a journal entry with no supporting documentation. That would be crazy. So, always look for the backup. Look for what was the reasoning behind this. Can you follow the logic? Can you follow the understanding of, okay, I see why they were making this adjustment, or that they were making this correction. Without that, you could have some not so great things going on. Number 4. These are usually pretty obvious in most companies. You've got physical and electronic controls. Things like you'll have cash vaults. Oftentimes at a retail business, underneath the floor or something like that is a safe where cash goes. Or a lot of companies have gotten to where the person who's responsible for that cash goes and deposits it at the bank. Usually there's no cash anywhere at retail establishments anymore. There are alarms, or you might have cameras. You'll have secured areas, and time clocks are also an electronic control. Number 5 is independent verification. This can be internal or external. A lot of large companies have internal audit staffs, and those individuals will do the second point there. They may do a surprise audit. They may go to the accounts payable department and actually look through the files, verifying that all the documentation to pay an invoice is there. Also, your external auditors usually will frequent the business as well to check internal controls. They will look at not only what you have documented are your controls, but they will verify that what you say is happening is actually happening. That's how they do those audits. And then finally, human resource controls. These are things like anyone who handles cash should be required to take a vacation. So, for example, I have actually been a treasurer at a church, and it's really important, for a church, for example, for their treasurer to take a vacation and have somebody else actually handle the cash and make sure that the processes and procedures around that work like they're supposed to. Also, if you've ever been bonded, it's an insurance measure that if you ever stole from the company, that the company would be able to get that money back. And sometimes I know people that run cash registers and things like that may be bonded. And then last but not least is anyone, and this is happening a lot more frequently now, but anyone who's handling large amounts of money in a company, oftentimes there are background checks. And the reason for this is that if you're already, in dire straits financially yourself personally, a company might not hire you to actually handle their cash. And I hope it makes sense as to why they wouldn't want to do that. Let's go through a couple of examples. I have, in the 20 plus years that I've been in the work world around accounting and accounting controls, I have run across a couple of instances of problems in this area. One of them was a company that I worked for where a plant manager used company funds to build his own house. And this was caught by the fact that we had a segregation of duties. So, for example, this plant, they would send all of their invoices to a group of accountants, which I belong to, and we would look at all of their accounts payable before they got paid and check to make sure that all the supporting documentation was there, etc., etc., that it had a purchase order, that it had a receiving report, and the invoice and all the signatures were there, etc. However, one day we started to notice that some common bills were coming through. And, that is to be expected. You buy raw materials all the time, so you should see those on a frequent basis. However, we saw an invoice for a public announcing system, this electronic system, of overhead speakers and things like that. And the first time we paid it, no question, and it's fine, had a purchase order, all that good stuff. But we noticed another invoice for the same thing. Now, that may not set off any bells for most people, but we're talking about a plant that only had 10 people working in it. It was a really small operation. So within 6 months, you wouldn't expect to have to buy another PA system at all. And so the more we dug into it, we found out that, okay, so even though there were second signatures on it and everything, the person who was providing the second signature was not really paying attention to what he was signing. And it was a touch and go situation there for this second signature person. He was afraid that he might actually be hauled in on charges as well for fraud. He wasn't, but don't let that, let that be a lesson to you that ignorance is not an excuse. He could have easily have been charged with fraud, even in an ignorant state. He had no idea what he was signing and what the plant manager was using him for, and so just let that be a cautionary tale to you. And then finally, another example is that I worked for an educational institution one time where a director siphoned money through fake payables. And the biggest problem here was the fact that from a documentation perspective, a lot of times documentation did not exist for the payment. And one of the other problems that was identified was the fact that from a pre-numbering standpoint, from being able to trace these things, I remember going into this same equivalent role, and with my accounting background, I was appalled because here's all this money that we're paying to faculty to do various different things, and we had no way of reconciling it. If I would look at one person's pay records for various things that we had paid them for, I couldn't figure out, I didn't know what this payment was versus that payment. There was nothing for me to trace it with. No unique identifier, no unique anything to help me to identify anything. So if a faculty member came to me and said, oh, hey, I have not been paid for blah, blah, blah activity that I have done, I had no way of proving it one way or another. So I could have very easily have paid that person 2-3 times for something that I had already paid them for. And so I rectified that really quick to make sure that we didn't do that. But those are the kinds of things that if you don't have a background in understanding internal controls, then you can easily get into this thing where you don't even realize what you're doing and what kind of problem that you are participating in. So I hope that this helps you to understand what these different controls do. And please, please, please do ask me questions in the comments. I would be happy to respond if you have questions about this. And I look forward to talking with you on another video. Thanks.